Okay guys, welcome back to the channel. Let's talk about stocks here. So we all know 2022 has been a rough time for stocks, but not equally across all sectors. We all know that value stocks have been going down, but a lot less so than growth and technology stocks. And that's the whole point of investing in value stocks that have lower multiples, lower earnings growth. They're more predictable and less volatile. And when it comes to growth and technology stocks, the reason why people invest in these is because they have the potential to balloon up in value and give you fantastic returns if you're willing to accept all that risk. But there are intelligent ways to mitigate the risk as much as possible and still give you exposure to the growth potential of those technology stocks. And the biggest way of doing that is to buy in at a lower, safer price. And the number one best way of achieving this is to go against the grain. So for example, back in 2020 when everybody was piling into growth stocks, that's not the time to buy it. And conversely, right now when nobody wants to buy them, might just be the best time to initiate a position. And I gotta say, I've been getting that feeling lately that as much as I don't want to, right now is the best time to build up those growth positions. And I came across this article that kind of confirms that same sentiment, and it says, the time for dividend stocks has passed. So let me quickly read a few highlighted sections here. So it begins by laying the foundation, and it says that we know from market history that certain asset classes tend to outperform during weak periods and then subsequently underperform during bull markets. And this is referring to value and dividend stocks. And he's essentially saying that they already served their purpose, and now it's time to reposition for the upcoming bull market, which inevitably will happen. But the big question here is the bottom of the market already in? Do we have 20% more to fall? Because if that is indeed the scenario, then we definitely want to stick with value and dividend stocks. But in this article, he makes the argument that from what I can tell, the bottom is already in, and I think there's a very strong rally in front of us. That has implications for one's portfolio because one of the areas that has outperformed this year is dividend stocks. That happens because during weak periods, investors go defensive, and high-quality dividend stocks are certainly defensive. But a little bit further down on the article, he talks more about the bull market incoming. So he says, as I detailed in the article I linked to above, I think we've already seen the bottom. Do we test the June low? Maybe, but I will be shocked if we break to a new low. The rotation I'm seeing from Wall Street suggests to me that the big money is betting on a rally later this year. So if that is indeed true, he goes on to say, one thing that means is that we don't want to own exposure to defensive sectors, but favor growth-oriented sectors as those will outperform during a market rally. So I totally agree with the logic, but to get more information on whether or not we are in a market bottom, here's the article he was linking to. So under the case for a bottom, he says, how can I call a bottom when we have a war in Ukraine, massive inflation across the globe, surging interest rates, plummeting consumer sentiment, and the threat of a recession looming? The simple answer is that the stock market always bottoms before the news cycle does. In other words, if you wait for everybody to tell you it's okay to buy stocks, the move will already be mostly over and you're buying in at much higher levels. And then the hard evidence he gives to support that we are at or near a market bottom is all around technical analysis. So we have a positive divergence, momentum is actually waning to the downside, the RSI is showing similar signs that the worst of the selling is now done, and he also references the VIX, which is a measure of fear and volatility in the market, and recently it's been at a high level, which does indicate a good buying opportunity, historically speaking. Now this random guy on Seeking Alpha isn't the only one saying that we might be near a market bottom. In fact, on CNBC, Jim Cramer says that charts suggest the market could find a bottom after a little bit more weakness. I'm also a big fan of this website, which is currentmarketvaluation.com. I'll leave a link down below, and they have a few core valuation models here, including the yield curve, Buffett indicator, PE ratio, interest rates, margin debt, and the S&P 500 mean reversion. In fact, let's click into that one right now. So the mean reversion is the fairly unsophisticated concept that what goes up must come down. It is generally true that while the day-to-day movements of the stock market are chaotic and unpredictable, long-term stock market returns tend to adhere to somewhat predictable upwards trends. And here's the actual chart of the historical trend line superimposed on the S&P 500. The exponential regression shows the approximate 10% annual returns that investors have been accustomed to receiving in the modern era. And we can clearly see things like the bear market in the 70s, the internet bubble in the 90s, as well as the Great Recession in 2008. And currently this puts us about 31% above the trend line, but this is within one standard deviation of the historical trend line after this most recent correction, which does technically make the market fairly valued. In fact, if you look at the sidebar, which lists all the valuation methods, currently all of them but the price earnings ratio indicate that the market is fairly valued. Now, as Jim Cramer said in the CNBC article, I believe there probably is going to be one more final shakeout to get all of these sellers out of the market before we can ultimately move higher. And if I had to guess, the catalyst for this is going to be the upcoming earnings season. Now, so far, surprisingly, this has been a positive event. So US stocks rose early Monday as Goldman Sachs reported earnings and revenue that blew away Wall Street estimates. The S&P gained around 0.9%, and even the Nasdaq is up 1%. And finally, the VIX is still at a pretty elevated level, historically speaking, at 24.5. Anything above 30 is usually a fantastic buying opportunity, and we might have all of those behind us, although, as mentioned, an additional flush out in the market could be a real possibility, giving you another opportunity. But if we zoom out to the absolute maximum view here, we never stay this elevated for that long. Now, to come back to this article, I'm not saying you have to sell your value in dividend stocks. In fact, it's probably a really bad idea because in a bull market, value stocks are going to do well. The point these articles are trying to make is that if this is indeed the market bottom, we might want to pivot towards more aggressive stances within our portfolio and stop being afraid of growth and technology stocks. So in the same way that 7 months ago when people pivoted to a more defensive stance that was beneficial to them, this could be another beneficial play if this is the bottom of the market and we have a pretty strong bull market ahead of us. But let us know in the comments down below what you think. If you're still watching and enjoyed, I appreciate a like, go ahead and subscribe, and I'll see you guys in the next one.